A fair value gap, FVG, represents an imbalance in price action. FVGs typically occur when price moves rapidly, leaving areas where buyers or sellers did not fully participate. These gaps often act as magnets, attracting price back to fill the imbalance before the trend continues. A fair value gap, FVG, is identified by examining 3 consecutive candlesticks on a price chart. An FVG occurs when the high of the first candle and the low of the third candle do not overlap. This gap indicates a significant price movement without complete market participation. A bullish fair value gap, FVG, is identified using 3 consecutive price candles on a trading chart. The second candle in a bullish FVG is a large green candle, indicating a strong upward price movement. The third candle in a bullish FVG opens above the high of the first candle. The fair value gap, FVG, is the price gap between the high of the first candle and the low of the third candle. A bearish fair value gap, FVG, is identified by 3 consecutive candles on a trading chart. The second candle in a bearish FVG is a large red candle, indicating a strong downward price movement. The third candle in a bearish FVG opens below the low of the first candle. The fair value gap, FVG, is the gap between the low of the first candle and the high of the third candle. After a fair value gap, FVG, forms on a price chart, the price often retraces back into the gap area. This retracement towards the FVG is referred to as filling the FVG, balancing the market. After the FVG is filled, the price may resume its original trajectory. The FVG retracement acts like a magnet, drawing the price back to balance the market. A bullish fair value gap, FVG, forms when price rapidly increases, creating a gap between the high of the first candle and the low of the third candle. The fair value gap, FVG, represents an inefficiency in the market where price may retrace to find equilibrium. Price often pulls back into the fair value gap, FVG, zone, offering a potential buy entry. Traders often look for confirmation signals within the FVG before initiating a buy order. Fair value gaps, FVGs, help traders identify high probability entry zones. FVGs highlight areas where smart money may re-enter the market. These zones often align with liquidity raids, market structure, and order blocks. FVGs enhance entry timing within an ICT, inner circle trader, strategy. A fair value gap, FVG, is a price imbalance that occurs due to strong directional price movement. Price tends to revisit the fair value gap zone before continuing in the original trend direction. Traders use fair value gaps to strategically time entries with favorable risk-reward ratios. Utilizing fair value gaps should align with broader market analysis techniques for optimal trading decisions.